This is so mind-blowing. I want to share with you something today that if you use properly, you may never have to pay taxes again, okay? And I'm talking about a $0 tax bill. Now, this is not going to work for everyone, but if used properly, it will work. In fact, you can verify this with your tax advisor, your CPA, your accountant. They all know about this, but see, so little people actually are able to execute this properly. So I'm going to show you two concepts that are super powerful, and when used appropriately, it's going to change your life. So let's go ahead and dive in. Okay, so this basically boils down to a conversation about tax deductions versus tax credits. Now, the deductions here, they are going to reduce taxable income, whereas credits are going to reduce the tax due. Two powerful concepts. So let's break this down a little further. So let's get into an example here where we have, let's suppose here that your taxable income is $14,000, okay? And your tax rate is 10%, okay? So 10% tax rate. Now we're not gonna go into whether it's progressive tax or anything like that. Let's just, for simplicity, let's just say it's 10%. And your tax due, so 10% times 14,000 is 1,400, okay? So that means basically you owe the IRS $1,400. Okay, so now let's show a $500, and let me just actually change my colors here. Okay, so now let's introduce the $500 deduction. So this is going to be a $500 deduction. Okay, deduction. Now that means, so we are deducting 500, so that means the taxable income is going to be reduced by 500, so that's 13,500. So far so good, right? You guys still with me? So that means, so the tax rate is still 10%, okay? So nothing changes there. That basically boils down to the tax due is 1,350. So it effectively reduced the taxable income, and now the tax due basically saving $50. Okay, that's nice, but let's go a little further with this. So next, let's look at a $500 credit. Let's see what happens if we get a credit of $500. What exactly happens here? Well, so now the taxable income is going to stay the same, so that is still going to be $14,000, and the tax rate is still going to be 10%. Now, this is where the magic starts to happen, because the tax due at this point, where it was typically $1,400, that $500 credit is going to be taken directly from the tax due. Okay, I'm going to put it in parentheses here so you can see that it's minus that. So basically, effectively, you are going to be owing the government only $900 versus just $50 in this particular situation here, okay? So basically what just happened here is you can see that the credit reduced your what you're paying the government, 500, whereas the deduction reduced it only by 50. Okay, so I'm going to draw a circle around this 50 because what happens here is that this is reduced. This reduces the taxes due, okay? That reduces the taxes due, all right? And that means it reduces it by this number here, the marginal tax rate, you know, times the marginal tax rate, okay? So $500 times 10% equals 50 bucks, okay? 50 bucks there. Whereas this number is going to be dollar for dollar reduced by $500, okay? So basically the bottom line is in most cases, the tax credits are going to be so much more powerful than the actual tax deductions.